The following presentation is brought to you as a courtesy from Forex Academy. This is part of our service Advanced Technical Analysis course. If you find it interesting and wish to be updated on new releases, please subscribe to our YouTube channel or join our community at forex.academy and receive all our services for free. Your like is also highly appreciated. Enjoy.
Hello everybody and welcome to the live Advanced Technical Analysis course. This is the start of a 3-week process whereby we will be running through 12 modules covering various topics related to technical analysis. And in today's webinar, the first of the 12 webinars, it will be essentially an introduction to technical analysis and will provide some explanation around the topic of technical analysis. Forex Academy is an online provider of educational facilities to traders of financial markets and cryptocurrencies. All of the content that you will view over the next 12 webinars is educational material, and it covers topics and tools that ultimately will contribute towards improving your ability to both analyze financial markets and as well as trading the instruments that you choose to trade. Just a few pieces of housekeeping issues before we continue. Please feel free to ask questions throughout the webinar. You can locate your chat box on the right-hand side of this, on the right of your screen. Obviously, I will be able to view all of these questions and will answer them accordingly. This is a live webinar. It is being recorded and it will be placed in your members area once the webinar has concluded. We will be hosting an extended Q&A session at the end of this live webinar, as we will for each and every webinar over the course of the next 12 sessions. That will obviously give you an opportunity to ask questions at the end of the webinar. It'll give us some time to go into perhaps a more detailed explanation, as well as potentially even a discussion on any topics that are raised, and this certainly will be of benefit to everybody joining us today and in each webinar. Now, in terms of the course overview, just before we begin, so you familiarize yourself with what is lined up, each week will be comprised of 3 educational webinars, essentially looking at and introducing various tools and techniques, and these will be delivered on Monday, Tuesday, and Wednesday of each week. On the Thursday, to end off the focus for that particular week, we will conclude the session with a workshop. This week we'll have the first of the 3 workshops, and the workshops essentially will focus on the tools and techniques that have been discussed in the prior 3 webinars, but taking a more practical and actually as well as a more real-time focus in terms of how to look at applying these tools and techniques, just so that you get a much more hands-on overview on applying the methodologies. Same will continue into next week, and then on week 3, ending that particular week with a course workshop, which will be slightly different to the previous 2, in that it will cover all of the topics, or at least look to incorporate a number of the topics that have been covered over the course of the entire webinar. The end of the Advanced Technical Analysis course will also be, or also included in the Advanced Technical Analysis course, will be a bonus webinar, which will essentially be an introduction to some advanced theory topics. It won't be a detailed focus on these various topics, however, it will just introduce a number of tools and methodologies that can be classified as perhaps more advanced theory, just to give you an introduction into what perhaps the next stage of your involvement with technical analysis could lead you into. Now, the timetable is the same for each webinar. It begins at 11:30 Central European Time, and that will be an hour ahead of UK time, if that is where your location is. These will run, as I mentioned earlier, for roughly an hour, and then there will be a 30-minute extended Q&A session. And those will be the time slots for each and every webinar, running Monday to Thursday, as of today, for the next 3-week period. The aim of the course, it was originally designed by Forex Academy, essentially due to a response from traders who would like to become what we would call technicians, or traders who extensively use technical analysis as their principal decision-making tool when it comes to both analyzing and trading markets. The purpose of the course then is to fulfill these demands. It is a specialized course and is seen as the second step in our exclusive training trilogy. The trilogy has been designed to assist traders in achieving the required skills a successful trader needs to have. The first course is our Live Beginners course, and the third is our Becoming a Pro course. In this particular course, what we aim to really do is to break down many of the pros and cons associated with each type of technical approach, and really just to get you to understand not just what the theory is behind a particular method, but also why it actually makes logical sense to apply it, and then also to think about how to then logically look to apply those tools and techniques if you do wish to bring them into your overall approach with respect to trading instruments in the financial markets. So essentially what we will do is we'll break down many of the pros and cons associated with each type of these approaches that we cover, and will essentially then leave you with the ability to make your own decisions when it comes to trading. And this is something, this final point is something that we'll come across in a later webinar as well. What is absolutely essential for you and every single trader is to be able to place yourself in a position where you can make your own decisions about where the market is going, and then how to look at potentially capitalizing on those decisions. What we don't want to do is promote a scenario where you continue to follow the views and ideas of other individuals. Formulating your own decisions is really an essential step to becoming a successful trader. In today's webinar, we will just cover a brief introduction of the topics that we will look at. We will spend a little bit of time focusing on the overall importance of historical price action, which is essentially what we are doing when we are using technical analysis. You'll see, not just in today's webinar, but over the course of the entire session, that technical analysis and price action are extremely closely linked. We will introduce you, or at least just cover a survey, just highlighting the market's overview and perception of technical analysis. We'll focus on why we can use technical analysis to improve our chances of success. Cover a few topics which are labeled the tenets of technical analysis. We won't cover all of them. This will be for a later webinar this week. We'll try and answer the question, what are we really trying to do by using technical analysis? Again, we'll come back to price, and this is something that we'll keep coming back to over and over again, and you'll appreciate why that is the case as we move through the various webinars. We'll also introduce to you some tools and applications. These will be an introduction to some subject matter that will be covered in more detail in a later webinar. We'll then also, once again, ask the question, how can technical analysis help me, just to get a much better understanding of why we should actually even bother considering using technical analysis. We'll just briefly see who uses technical analysis in the financial marketplace. And then finally, we will just draw a comparison between what technical analysis is and what fundamental analysis is. This also forms the topic of a later webinar, which takes a much more detailed look into why we should be using both technical and fundamental analysis, and how one can consider combining the two approaches to build a much stronger and more effective ability to both read the markets as well as trade them. Okay, so what is technical analysis? Essentially, technical analysis in a nutshell is the study of price. And this is really ultimately what we will be focusing on. Another way of perhaps looking at this is that you can view price as your primary indicator. In other words, and this will become clear when we use things like momentum studies or oscillators, whereby we are looking at warning signs in the market, but only the price action can confirm those warning signs. So you could view price as your primary indicator. Only price can ultimately tell you at what level to consider trading a particular instrument. It will indicate when you can make that decision to either buy or sell a particular instrument. So something like timing will become very clear as we move through various webinars. And price will then also provide you with the remaining elements of a trade in terms of the parameters that make up an overall trade, i.e. the objective as well as your risk parameter. In other words, where does your stop loss lie? So technical analysis is the study of price. What this essentially means then is that we as technical analysts are studying historical data to anticipate future outcomes. Looking at it another way, what we are doing is we're studying the market's past performance to predict its future decision making. Now, this makes absolute sense because when we look at a particular chart, as we'll see very shortly, what we don't have at our disposal is what the future looks like. If we're studying price, there's a certain amount of price activity and decision making that has already taken place, and therefore that is the element that we can study, and that has already occurred. So technical analysis is not just the study of price, but it is the study of historical price action. So what we're essentially doing is we are coming to the conclusion that certain decisions that the market has made in the past could give us an indication into the types of decisions that the market might make in the future. And this is really possible because there exists some predictive data in price activity. Now, not all historical price action contains predictive data. There certainly is still some random elements in that data. But what technical analysis is essentially doing is it's focusing its attention on the predictive element of this historical data, because what we can then do is extract the information from that, and it can give us some insight into potentially what the market is likely to do in the future. If price action were entirely random, the data would contain no clues about potential future outcomes. So it would be an absolute waste of time for any of us to study price activity. And this doesn't just relate simply to technical analysis, it relates to any approach that one would apply to try and predict the future outcome of markets. So even from an economist or a fundamental analyst who would tend to focus on what impact certain developments might have on the price movement of a particular instrument, the only reason that that can be applied is because there needs to exist some predictive element of market behavior. And market behavior is summarized in price action. So we're not focusing our attention on the random element of price action. We as technical analysts are focusing our attention on the predictive element of price action, because that can give us some clues about future activity. So essentially, from what we've discussed thus far, is we're looking, let's say we're technical analysts now, we're looking at this particular chart, and our goal is to try and determine where price action is likely to move from this point over here. There's three possibilities. Price will either move up, will either move down, or it may continue to move sideways. What we will be doing as technical analysts is we will be understanding what price action means from here to here in terms of evaluating the overall condition of the market, why it perhaps would have been possible to predict this move when prices started to move in a downward direction, and then what the implications of this activity are and how we can use that information to determine certain strategies about future price action. And you can appreciate, just in terms of what we've looked at thus far, this is our borderline, so to speak. What we're doing is we're looking at the past to try and determine the outcome of the future. Certainly not an easy task for yourselves, for myself, or for anybody trading the markets. But what we can do is we can compile strategies, we can use various tools that can increase our chances of ultimately being correct from this particular point over here. Okay, so let's look at moving on. And before we continue, it might just be of interest, we feel, for you to just appreciate how much the market's perception of technical analysis has improved over the years. Now, this is a survey result going back to 1989, and it was essentially a survey that came to the conclusion that technical analysis had some value. The statement was made whereby standard economic analysis, this was applied to foreign exchange, apparently has some limitations. Like everything, nothing is perfect. There are going to be limitations to various approaches. And this standard analysis was not adequate enough to explain either the past or predict the future reliably. So financial market researchers should not dismiss technical analysis, was the conclusion. And some chartist forecasts were actually good and perhaps couldn't even be improved upon by a range of alternating forecasting procedures. This was a survey done by the Bank of England, just looking at the foreign exchange market back in 1989. Now, I've been involved with technical analysis for over 20 years. I've worked in the investment banking industry, and I've dealt with a number of financial institutions. And basically, I could say that the appreciation in terms of the value and the benefit that one can achieve through the use of technical analysis has certainly improved over time. More and more participants in the financial market industry are using technical analysis and becoming familiar with the various tools and approaches. One final just interesting point regarding this survey, my apologies, is that 60% of the respondents regarded technical analysis at least as important as fundamentals for relatively short periods. This is not a surprise when it comes to foreign exchange. Generally speaking, most foreign exchange participants and traders trade these markets on a relatively shorter term basis. But this can be extended into all markets, and certainly this general perception of the relative importance of technical analysis has grown across all of the asset classes over the years. And then just finally, it's interesting to note that at least 90% of these respondents back in 1989 said that technical analysis formed part of their analysis. That certainly, in my opinion, I don't feel has changed over the years. So in terms of improving our chances of success. Now, at this stage of the webinar and the course under this advanced technical analysis feature, it's not important for you to understand what these lines in the chart mean, apart from the fact that once you've completed the course, and certainly as we move in from one webinar to the next, you will come across certain tools and techniques that will help you understand why we can draw some conclusions from price action that we're focusing on over here, and why that ultimately may have suggested, even during this process of moving higher, that ultimately price was likely to move in a downward direction. These are some of the skills you'll be introduced to, and some of the skills that you can develop and work on over time to improve your analysis. If we look down at this section over here, we'll understand why this development was quite important, why the market started to really accelerate in an upward direction once it moved through this area over here, and how we could then also have used that information to try and capitalize it from a trading perspective. Again, we will develop and look at tools that can suggest, provide, even potentially provide us with an early warning sign that perhaps something is changing in terms of market sentiment. This is something I'll touch on very shortly, why that might be changing at that particular point. Ultimately, we see price action move down. Most importantly of all, we will then use all of this information to try and determine what we need to potentially consider from current market prices. In other words, should we be looking at opportunities to go long, or opportunities to go short, or perhaps apply some trading opportunities that might capture a sideways move in price action. Sentiment is a topic and a word that will be used over and over again throughout this course. What one should appreciate when looking at price action is that it is a reflection of what the market is thinking. If price action is moving in a downward direction, as we've seen during this period over here, then we can come to the conclusion that in terms of the relationship between buyers and sellers, there have to be more sellers than buyers. In other words, if we're looking at translating that information into sentiment, the sentiment has to be bearish. For whatever reason, the market is not comfortable being long this particular instrument, and as a result, price action moves down. The opposite is true during this period over here. Because prices are moving in an upward direction, there clearly is a stronger level of buying interest. Therefore, market sentiment is bullish. So our challenge as technical analysts is to determine whether at current levels we are likely to see a bullish outcome in price, or a bearish outcome in price, or perhaps a neutral outcome in price where price just moves in a sideways manner. And this is essentially how we'll be tackling our decision-making process when applying all of these various tools. We're trying to come down to a conclusion whether we believe we need to be bullish, bearish, or neutral. The basic tenets of technical analysis. Now, there's 4 concepts that we'll look here. These are very important concepts because a strong understanding of them essentially is required for you to then be able to apply the tools that make up technical analysis. And the first is that the market discounts everything. Now, this is probably not a new concept to anybody, but it is something that we all need to appreciate. Remember that the market is forward thinking. It's not looking at just reacting to current developments. While there certainly is that aspect in price decision making, but the more dominant price decision making process is to price in future developments. So if we take in a particular example, at the first Friday of every month, there is a very important data release known as the non-farm payrolls. It's an employment report that comes out of the US. This is a data release that has traditionally a very strong impact on the market. Now, what typically would happen is that the various news agents, be they Bloomberg, Reuters, or any other financial related news agent, would be interviewing economists. They would be evaluating what those economists feel about the next unemployment release in terms of the payroll numbers. Have they gone up by an X amount? Have they gone up by a certain amount, gone down, sorry, by a certain amount, as well as the unemployment rate. Is it going down, up, or staying the same as the previous month? What that will essentially do is it will develop a consensus number around which the market can then focus its attention on. Now, if we are 3 or 4 or 5 days out ahead of the release, this is something that will impact the market's trading decisions around, for example, euro-dollar. Because this is a US release, it will have an impact potentially on the US dollar. So if the market feels that this is going to be a strong number, then most likely what we'll see is leading up to the number, demand for the US dollar will increase, and that could then push prices higher. What the market will then do, once this data is released, it will evaluate what the actual release is relative to what the discounting process was looking for, and then it will make the necessary adjustments. It's very important to understand that in terms of what the market is doing vis-a-vis its decision-making process, it's always, for the most part, pricing in future developments. Admittedly, though, certain things take the market by surprise. There is a development that occurs that the market could not have been anticipating, and that then causes a shock reaction by the market because it needs to assess what the implications are of that development. And probably the clearest example would be to illustrate the horrific events in New York known as 9/11. This is something that nobody could have predicted. The market wasn't anticipating, therefore there was no ability to discount this development into future price developments. On that particular morning of that particular day, the two planes flew into the Twin Towers, and there was a massive reaction by the market because they needed to assess what this meant for market prices. So there was an impact on equity indices, there was a strong impact on some foreign exchange prices, particularly the yen, for example, as well as the dollar. These are elements that take the market by surprise. This obviously doesn't fall into the area of the market discounting everything. For the most part, we know what information is coming out in the future, and the market is dealing with that accordingly. The second point to note is that prices move in trends. You'll appreciate as we move through this study of technical analysis that essentially what we're doing is we are analyzing trends in the market. Is the market moving up? Is the market moving down? And also, importantly, is the market moving sideways? There will be a dedicated webinar to trends that will look into these three components or these three directional moves in much more detail. Importantly, for and from a technical analysis perspective, is that history tends to repeat itself. This is absolutely essential in terms of us being able to predict the future. It's an extension of the argument that we highlighted earlier, whereby when we're looking at price action, we know that there exists a totally random element of price action, which is what we are not looking at in terms of evaluating. There also exists a predictive element of price action, which is the information that we're trying to extract to predict the future. Now, this predictive element then naturally has to be able to repeat itself to a degree in the future. So what history tending to repeat itself essentially means is that past behavior by the market or behavioral elements by the market tend to be repeated in the future, and therefore if we see any of those behavioral or are able to identify any of those behavioral elements in price action, that will then allow us to draw some conclusions about future developments. And this is a topic that will become very clear again in a later webinar where we look at price patterns, both reversal patterns and continuation patterns. The fact that history tends to repeat itself can be broken down into various pattern structures which have tended to deliver the same or a similar result in historical studies, and therefore we can use them to determine what our view is of the future. So history tends to repeat itself. Finally, and this is just an extension of the previous point then, that if price or history is repeating itself, that then essentially means that human behavior or human psychology has a repetitive element. It is repetitive. And this is essentially why we are able to, first of all, study price action and apply technical analysis techniques to price action to determine future price movements in financial markets.